Hello and welcome. Thank you very much for watching this first video of a series of 3 on option overlay strategies. Now, many of you have been investing in equities for quite some time, either directly through stock ownership or through the investment in mutual funds or exchange-traded funds. You may or may not have heard of incorporating options into your strategy and how they can help you achieve your investment goals. Options are most often misunderstood, and I would dare say that sometimes they're even abused in terms of their intended uses. With this short video series, we intend to teach you the basics of 2 option strategies that we use here at Exponent. And after the series of videos, you'll be able to decide whether an option strategy is something you'd like to incorporate or at very least learn more about. Now, the 2 investment strategies that we're going to talk about in this series of videos is really the intended strategies are to provide more income from the portfolios, especially given current interest rates. That's always a popular theme. And not only that, but the income that is derived from the portfolios is considered capital gains. And in Canada, capital gains are taxed very favorably. Now, my name is Benoit Poliquin, and I'm the lead portfolio manager and president of Exponent Investment Management. Thank you very much for watching. Let's start with the obvious. What is an option? Well, first of all, it's a derivative security. So what do we mean by derivative? We essentially mean that the option's price is derived from something else. In this case, in the case of an equity option, this something else is the underlying stock price. An equity option, by definition, is the right but not the obligation to either buy or sell. You can do both. There are 2 kinds of options. The obligation to buy or sell the underlying stock at a defined price by a certain date. There are 2 kinds of options. There's calls and puts. So the right or not the obligation to buy a stock, or the right but not the obligation to sell the stock. And the 4th point is the example of a ticker or a symbol of an option. So we have GE 150515C26. The first 2 characters corresponds to this stock, the underlying stock, if you will, in this case, General Electric. 15 is the year, 05 is the month, 15 is the day in this case, and second 15 is the day of the expiration. In this case, it'd be May 15th, 2015. C refers to the call, and $26, or 26 refers to $26, which would be the stock price, or the strike price at which the owner of the call can exercise his or her option. So why do we bother with options in the first place? Well, options are a great tool to speculate. Why? Because you can, for very limited capital up front, you can have some pretty fantastic leverage in terms of moves based on the underlying stock price. The other intended use, usually for options, is to hedge. So you might be long GE and you want to hedge off because you're worried about a decline in the market or a decline in GE particularly, and options can help you hedge or mitigate the risk of a loss. We use option strategies to generate more income. What we like to say is that we convert volatility into cash or income. We're going to talk about that a little bit later in the series, in the 2nd and 3rd series. So for us, options are really a tool. That's why we call them an overlay, to increase the portfolio's income. And this income, as we said earlier, is taxed very favorably. Now there are 2, this is very important, there are 2 types of options, calls and puts. So the right but not the obligation to buy is a call, and the right but not the obligation to sell is a put. So through this 1st and 2nd videos, we're going to use, or even the 3rd video, we're going to talk about, we're going to use live examples. So in this case, the live example we're using is GE. So currently, at the time of writing and producing this short video, the market price of GE was $24.75. And we'll just use here in this example GE, but in this case it's June 15th and 2015, and the strike price being 26. And at the time, the call was selling for 32 cents. So the person, the investor, speculator, or hedger, if he or she wanted to buy the call, it would have been for a price of 32 cents. So let's look at the profit diagram, and we're going to show the difference between buying a stock, which is our orange line here, and what we call a covered call, which is essentially selling a call when you own the stock. So I'm going to take out our little laser pointer here, and this is what I mean. So the orange line is long the stock. So we pay $24.75. So anything above that is our profit. Anything below $24.75 is to the left. So if we sell the call at a strike of 26, we cap our profit at $1.57. Anything above $26 is owned by the call buyer, sorry. And so the owner of the call, or the seller of the call who's still long the stock, owns the profit, but below $26. The loss, however, obviously, because you own the underlying DE stock, if the stock falls below $24.75, well, you're in the same boat as those that did not sell the call. You'll notice, though, that the line is a little bit to the left, and the difference between the two is the 32 cents that the option seller collected. So a covered call is a situation where a stock owner, person who owns the stock, decides to sell the option or the right but not the obligation to buy stock. And the strike price refers to at which point the seller of the option is willing to give up. So in effect, in this particular trade, the person gave up the profit above $26 for 32 cents right away. So the green is still the profit that is owned by the covered call owner. So let's recap. A call option is the right but not the obligation to purchase an underlying stock. The strike price is the price of purchase. The expiration date, if you will, a best before date of the option. And it can be a buyer of a call and a seller of a call. In the next video, we're going to talk about two concepts that are very, very important to option pricing, both volatility and time. Now, thank you very much for watching. This concludes our first video. If you like what you saw and heard, feel free to contact me by phone at 613-747-2458 extension 40, or write me an email. Thank you very much, and stay tuned for the second installment of the series of 3 videos. Thank you very much.